Hey guys, 𝗥𝗙𝗙𝗖𝗓𝗏 from 𝗢𝗙𝗏 here, and today I'm going to try and answer the impossible question, is Alibaba a value trap? Now, actually, for this video, I wanted to check what a value trap actually was because I've heard it used so many times in a lot of very different ways. Investopedia defines a value trap as a value trap is a stock or other investment that appears to be attractively priced because it is trading at a low valuation metric, such as price to earning ratios, price to cash flow, or price to book value for an extended period. A value trap persuades investors because the trade appears to be inexpensive relative to the historical valuation multiples of the stock, industry peers, or the prevailing market multiple. A value trap can drop further after an investor buys into the company. It is basically written into Warren Buffett's DNA to buy stocks that suit this definition. Again, let's go back to the definition. A value trap persuades investors because a trade appears inexpensive relative to the historical valuation multiples of the stock. Yes, I am buying things that appear to be attractively priced. Now, it's not uncommon for Warren Buffett to pay quite high multiples relative to the earnings of certain stocks, but when Warren Buffett does this, he is typically extremely confident in the company's ability to grow. However, Buffett's confidence in growth typically comes not from innovation, but from things that typically never change. So what Warren Buffett knows is even if we have a recession in the future, people are still probably going to buy Coca-Cola. Even with companies like Apple that are known to innovate really well, Warren Buffett didn't pay a high multiple for Apple. When he first began investing in Apple, the multiple was around 8 relative to the earnings. The thesis of people selling Apple at this time was that the size of the company had maxed out. iPhone sales and MacBook sales had all started to slow down, and people believed that there wasn't much innovation left in the company at the time. What happened was Apple was previously priced for growth, and then the second it didn't have this enormous explosion in growth, what happened was the share price's multiple came down. When that share price came down, all these negative articles start coming down, and then people start believing in this negative trend, and that is when Warren Buffett comes in, when people have freaked out to the max. What followed after Warren Buffett bought was that Apple performed reasonably well, especially well, compared to its price to earnings. Its price to earnings of 8 did not reflect much growth. However, Apple did grow. And then when the pandemic came, Apple grew enormously. Now, had the pandemic not have come when it did, I do not think Apple or many of the tech stocks would have performed half as well. As you can imagine, people getting stimulus checks at a time where they're also locked at home, using these tech devices more than ever. They're going to buy top quality stuff, and they're going to pay for Apple TV along with Netflix and Disney Plus and things like that. So the pandemic was enormously useful for Apple. Now, the reason Warren Buffett did so well of this stock was not because of the pandemic. Like I said, prior to the pandemic, Apple was doing really well. The reason Warren Buffett did so well off this stock is because he bought into it at a time that the stock was considered a value trap. And by the way, with him selling shares now, my thesis on it, we don't really know what he's thinking, but my thesis on it is that Apple can't continuously keep hitting sixes. He even sold, if you remember, a few shares in the pandemic. I haven't really gotten the exact figures up for this video because this video is about Alibaba. It's just, this is important context before we get onto that. Apple have rolled sixes over and over and over again, and Warren Buffett knows that just can't go on forever. Apple don't have some sort of special way of rolling sixes. What happened was they are a very good company who had a very fortunate time during the pandemic. Now, when I talk about rolling sixes, and this is going to be really important for Alibaba, I'm talking about this imaginary dice game I have where if I roll a 6, then I win big. Now, I, the investor, have a choice between 2 dice. One dice has rolled 6 10 times in a row, while the other dice, which I've seen roll 6s before, hasn't rolled a 6 for over 5 rolls. Now, here's another important thing to remember. In this game, every time a dice that is rolled hits 6, the amount you get when it rolls a 6 again goes down. This is the equivalent of Nvidia. Every time it gets 50% growth, then people start pricing the stock as if it's guaranteed more and more to get 50% growth. Whereas the other dice, every time it rolls a 1 or a 4 or a 3, every time it rolls one of these numbers, the amount that you get when it hits 6 goes up. This is what I would call the value trap. If there's something inside that dice, a little weight, that is keeping it from landing on the 6, that in some way this dice is secretly rigged. And the thing is, the way that I invest, if you go check out my portfolio, 𝗥𝗙𝗖𝗱𝗲, you can go check out all my trades, all my investments on there. I've got a lot of what people would consider value traps. And the fact is, I have not been able to identify any reason that that dice cannot land on 6. Some of them will have legitimate reasons that they can't, but this is why you diversify, right? I don't need all these positions to succeed. I just need a few of them to be worth paying off. And as we've talked about the alternative, buying dice that can't help but land on 6, we absolutely know that there are many ways that these companies can roll 4s, 3s, and even 2s and 1s. The issue is in investing in those, if they have a trap of perceived value, but actually they have the ability to roll 1s and 2s, the issue of investing in those is, as we've said, when they don't land on 6, it's really bad. When a value trap lands on a 3 and a 4, basically very little happens. And where Alibaba is right now is it's basically priced as if it's going to be rolling 1s and 2s for the rest of its life. So guys, there's the context. I'm sorry if I over-explained, but I really wanted to get into people's heads how investing is more about odds than it is about gambling. And so with Alibaba, for it to be a value trap, there would have to be something hidden that is keeping it from rolling 6s. The first thing that I think people blame is China, Americans' trade war with China. But for China to be the issue, that would have had to been an issue when the stock was exploding. When the stock was rolling 6s back before the pandemic, that did not dampen the share price or the company's multiple. The next thing I get seen blamed all the time as to why people won't buy Alibaba shares, this isn't so much what people call a value trap about Alibaba, but I see a lot of people mention the ADS shares, the American Depository Shares. Essentially, again, this is just a fear of China because China technically owns these shares. These shares are technically held in Beijing, but I don't really understand these shares either. All I know is that no one cared about ADS shares back before the pandemic. Maybe some people did, but when the share price was exploding, again, nobody cared about the ADS shares, or at least the fact that these were ADS shares didn't stop them from going up in value. What has happened is Alibaba's share price has gone down and people are looking for scapegoats to try and explain the falling share price other than the fact that its earnings have been going down. Again, I don't fully understand people's fear of ADSs because I think what they are afraid of is that the CCP are going to start cracking down on America investment, foreign investment. China love foreign investment. The people on the party of the CCP are ungodly rich. China has the most billionaires in the world, I think, right now, or at least they are very high up there. They are a very wealthy nation and they love capital markets and money. And where that money comes from is foreign investment. So they love foreign investment. And also, I'm sure the CCP tell Alibaba very, very little about what they plan to do, but I still think Baba, if they had any inkling that the CCP were just going to crack down on these shares and take them because they are sitting in Beijing, I believe they're sitting in Beijing or something like that. If Baba had any inkling they were going to do something like that, they wouldn't be buying back billions of US dollars of these shares, or at least surely that theory has to be dampened by the $1 billion worth of buybacks. Surely that theory is weakened when Alibaba buy back shares. But I don't think these people are really using logic and reason to determine whether ADS shares are a risk. They just they probably exited at a loss and are looking for anything to justify the reason for their exit. They want to feel good about the fact that they closed their trade at a 50% loss. and this is one of the ways to feel good about it. If anything, I think these people that have exited at a 50% loss would actually be happy to see China crack down on these shares so that they could prove that they were right. I just don't think there is evidence right now that the CCP are going to do anything like that. For this stock to be a value trap, there has to be a new intrinsic reason that it can't grow. I accept that this stock has had crap growth for the last 3 years, but surely that reason is for the pandemic. And I get that we should be exploding out of the pandemic, but there is a housing crisis, an economic crisis going on in China right now. And that, again, is a real issue, but these crises are usually overblown. Certainly in the West, we've had plenty of financial crises. 2007 was absolutely huge, and we came out of that booming. What happened was the prices of everything dipped, and if anyone bought at that low where there was the biggest amount of people calling that is when most people would be saying all these stocks are value traps, or that basically the market is never going to recover from this, or it's going to take 10 years. I think people will be surprised. I think there could be one good argument about how the stock is intrinsically different from where it was pre-pandemic, and that is the loss of the CEO Jack Ma. I definitely think that this is a potential issue for Alibaba. Now, with regards to Jack Ma as a CEO in particular and what that's going to mean for Alibaba, provided the new CEO is taking the company down the right direction, then this shouldn't be an issue. And also, I do believe that a lot of times the CEO is and the management, Warren Buffett and Charlie Munger do talk about management a lot, but they also, I think a lot of people miss, is that they talk about the fact that there's an overemphasis on management. I think it was The Intelligent Investor that I read this, but basically if you take the management team with the best reputation in the world and put them in charge of a company that has the worst reputation in the world, it is the reputation of the company that remains intact. And what's interesting is there's some theory as to why this works, and the reasoning is good companies with a good product and a good business don't have to work that hard in order to sell their product and make their earnings look good. A good example is Coca-Cola. The management team at Coca-Cola really need to do very little. If anything, they just need to make sure everything stays the same, and then customers will still show up and continue to buy Coca-Cola. Buffett even put this into numbers. I believe 70%, he was like, if the company is making 70% margins, that company is not going to need to do any dodgy things in order to show profitability. However, if a company is making 10% gross margin, well, that company is struggling and it doesn't have a strong competitive advantage, and it can benefit greatly from doing dodgy things to try and attract investors towards buying the shares of the stock. This goes double for companies with no earnings whatsoever. And so Alibaba, with its current margin, I believe, of 20 to 30%, which is low relative to his historic levels. I mean, in the past, it's had around 50% gross margins, which is incredible. It's very unlikely to be doing dodgy things in order to manipulate its share price. In fact, while it's buying back shares at these quantities, they're probably happy with the share price being where it is. Now, Alibaba to an outsider might look like a complicated high-tech internet company with Alipay and Alibaba Cloud and all of these things, but in reality, it's a very basic internet retail company. The big thing that has changed, and it's the reason that I believe the margin is dropping, is that they've gone from using third-party delivery companies to becoming the delivery company. Essentially, imagine Amazon relying on DHL and FedEx to ship all their products, where Amazon a few years ago invested billions in making them the delivery provider. This gave them far more control on the service. It was able to cut costs on delivery, and it was able to increase profits and margins, which has been enormously beneficial for the share price in the long term. Now, because Alibaba relied on third-party delivery companies in the past, they were able to grow and reach all these regions, enormous amounts of regions, incredibly fast at extremely low margins, because one of the most expensive bits of delivering these products is delivering these products, especially the last mile. Amazon, I believe, estimate the last mile to be 1/3 of what the customer pays for the product, which both makes sense and is insane. Think of everything you buy. The most expensive bit of it is just that guy bringing it round to your house. If you can cut costs here, it's going to be a huge competitive advantage, and it's something that I believe that Alibaba are closer to achieving. If you didn't know, Alibaba already have a huge network of completely autonomous vehicles already on the road. People just walk up to these self-driving vehicles, they get a little text saying it's outside their building, they walk up to it, unlock it, and pull out their parcel. Also, for reasons good and bad, people in China are very unwilling to do anything that will get them in prison, whereas people in the US seem extraordinarily likely to vandalize these autonomous driving robots and also steal the parcels out of them. On top of this, I've worked with people in China. There's a factory that we had in China and that I communicated with for years. And these people get really excited for new technology, whereas in the West, we're always extremely apprehensive towards anything new. And when Amazon was investing in all this infrastructure, its margin, its gross margin for the business, its revenues continued to climb, but its gross margin for the business dropped to around 20%. So long as Alibaba doesn't drop below 20%, and we can see that they're succeeding in developing this infrastructure in these autonomous vehicles that are delivering products to people's houses, then I'm not too worried. And what I'll be excited for is after this investment has been made. By the way, guys, one of the benefits is that if retail, if high street warehouses and everything are cheaper now, then they are potentially buying warehouses and stuff like that at rock bottom prices while they have this huge cash pile to take advantage of. But yeah, so while they're investing in this aspect of the business, over time, in sort of 5 years' time, I expect to see the margins return to around 50%, and then also the customers will start to benefit from the fact that Alibaba has invested in all this infrastructure and it costs so little to take the product from a warehouse to their front door. Alibaba want to be able to deliver any product anywhere in the world in 72 hours. I'm always in favor and excited to invest in companies that have ambitious missions like this. Whereas if you look at the West, what sort of ambitious mission does Apple have right now? Or what sort of ambitious mission does Google have right now? Right now, it seems that all the big tech companies are just copying OpenAI and trying to latch onto that as a way of keeping their multiples high, but they don't have an actual mission or something that they are currently working towards. That is with the exception of Tesla. And so I do think that the people online that are just screaming value trap and don't invest in China are missing this investment into autonomous driving and autonomous delivery vehicles. I mean, just think Amazon are going to want this technology if Alibaba get it right first. And by the way, we already have all the cool driverless warehouse tech that Amazon has because all the factories that built those robots are in China and Alibaba got them way cheaper. And also, guys, just because growth is going to be slower while we are investing in becoming the delivery part of the process, it doesn't mean that it's going to be slow. When Amazon was investing in becoming the dispatcher of the product, a move that has made them incredibly competitive today, it still grew enormously. Much like I'm hoping that my portfolio will do on eToro. So please feel free to go check that out. 𝗥𝗙𝗖𝗋 on eToro. The thing that you need to do if you want to be rich is